What will actually happen? Scenarios and not predictions. Markets do not crash the way you think. Everyone is asking the same question right now. What will happen next? Will prices fall? Will investors leave? Or will the market crash? But this is the wrong question to ask, because markets do not move based on predictions, and instead they move based on structure, and structure changes long before headlines do. In the previous episode we spoke about possible paths, 3 directions the market could take, but today we go deeper, not into guessing the future, but into understanding what actually changes inside the system. Markets do not simply go up or go down, instead they restructure. Different parts of the market move at different speed for different reasons. And if you don't clearly see that, everything looks random. To understand what happens, you need to see the market at different 3 layers. Layer 1, speculations. Layer 2, end users. And layer 3, capital preservations. These 3 layers behave completely different inside the market. Let's start with the first scenario. Not tension fade, but what actually changes when uncertainty disappears. When uncertainty fades, confidence does not return instantly. In fact, it rebuilds gradually. But something else happened immediately, which is flexibility disappears and developers become stricter. Discounts shrink, payment plans tighten, and the same opportunities that existed during uncertainty quietly closes. So, paradoxically, the safe moment is often the moment with the least opportunity. Now, the second scenario. Not tension escalate, but where does the pressure appear first? Markets do not break all at once. Instead, they fracture in sequence. First, speculators. Those who entered expected a quick exit. Next, payment plan buyers under pressure. Then, secondary liquidity slows down. But the core market does not collapse. In fact, it compresses. And markets only collapse when their fundamentals break. Not sentiment, not headlines, but fundamentals, which is when liquidity disappears, and when the finance dries up, and when demand structurally weakens. This is where a system begins to fall. And luckily, this is very different from what we're seeing today. So what people call a crash is often just the removal of weakening positions in the system. Now, the third scenario. Not safe haven, but when does capital actually move? In the early stage of uncertainty, capital does not move. It actually pauses, and it observes, and it waits. Because capital is not emotional. Matter of fact, it's strategic. And it does not move when risk is high, but it does move when risk becomes defined. And only then does the capital relocate towards stability, towards system it trusts, towards cities like Dubai and Abu Dhabi. So the safe haven effect is not immediate, it is delayed. And by the time it becomes visible, the best opportunities often already gone. Most people look at the market as one chart, up or down, but in reality it is multiple systems moving at once. So the real question is not what will happen to the market. The real question is, which part of the market are you actually in? If you are in speculations, this period feels dangerous. And if you are an end user, this period feels uncertain. And if you are positioning capital, this period becomes selective and sometimes very strategic. Markets do not reward predictions. In fact, they reward positioning, because the future is never a single outcome, but it's always a range of scenarios unfolding at the same time. And through Archi lens, we are not trying to predict the future, but we are trying to understand the system. Because when you understand the system, you don't react to the market, but you position within it.